Right. Morning, everyone. Welcome back to Morning Kappa at 8. I'm Joseph here. Hope you had a very good long weekend break. So looking at the yesterday Hong Kong market, right? Can see that the sentiment was bullish following the opening of the first day meeting of uh, the Chinese Communist Party, right? Xi Jinping have mentioned that the China is going to um, roll out the high quality development and be focused on the technological innovations about ensuring their national security. That actually have boost the market sentiment overall. So yesterday you can see that the at the Hong Kong market, right, from the tech stocks to the insurance, even the exchange and some of the small cap counters overall, well, we saw a broad-based rally yesterday, particular on the AI related counter 9880 also went up by 10% yesterday, right? One thing furthermore is that overnight, right, at the US market, we do see the HXC have rebound sharply, now climb above the 50 days moving average. Hence, we believe that this bullish momentum that we've seen on the Hang Seng Index should follow through today. So if the Hang Seng close above the 50 days moving average, that should resume the upside movement towards 27400 point level. So overall, we still keep a bullish bias on the Hang Seng Index futures with our stop loss point at the nearest support level, i.e. 25,000 point level. Okay, and these are the watch lists unchanged. And since the market right now is going on a positive sentiment, right? You may look at the big cap stocks, especially the tech stocks that we have highlighted over here. All right, and apart from the tech stocks, you can also watch at the commodity stocks and some of the consumer stock as well. Just recall that Xi Jinping has been a few months back mentioned that he's not going to encourage the company to go on price war, and that will actually leave some of the uh, sentiment on the consumer stock as well, right? And okay, apart from the Chinese news, we do see that the right now, yesterday the IEA have mentioned that they do see that the oil market will have a slight surplus in 2026, and that if the surplus number the IEA is looking at slightly different than the OPEC, as we know that right now OPEC is increasing their productions, and one of the key reasons that IA is seeing the oil market have a surplus due to a weak demand on the oil, and secondly, there is a stronger demand on the renewable energy right now. Okay, and the other thing that let's look at the Europe and the US equities market. We do see that the XXP continued to move upward yesterday, and the S&P also S&P 500 have resumed their upside movement yesterday. So right now the S&P is on track to test their resistance at 6850. Looking at the uh, okay, I haven't get the price action yet, but we do believe that most of the counters should have rebounded yesterday. Okay, and so these are some of the theme that I'll be looking at in the US market. Start off with the AI servers related, and then on some of the memory counters. Now, one sectors that I really urge you to actually take a look on, which is the cybersecurity segment that we have Palo Alto, CrowdStrike, the Datadog, CyberArk, and also the ZX, right? And then on last week, the bank have released a string of good results. This week, we're going to have the results from the Intel as well as the Tesla that yet to released. Okay. Um, so there will be two FANG stocks, Tesla and Netflix, to release their result, and followed by one aerospace counter, GE. Then on, I think all I will be on the um, Intel that's going to release their result on the 2 days later on Thursday. Okay. Right, looking at the Malaysia market, last week we closed on Monday. We closed for the Deepavali holiday. Market went to a profit-taking mode before we closed on the Friday, and we do see that although there's a corrections, but very strong support should be at 1550 right now. And based on the weekly chart, FPM KLCI remains above the 20-week moving average. So we view that these corrections is a healthy pullback. Overall setup remains bullish so far. And last week, we do see a very strong flow into the consumer sector, and our analyst Wei Xiang have published a sector report on the consumer. You can actually pick up what he have written on the Speedmart and as well as the DIY. And secondly, the market, since the market actually went on the selling on the Friday sessions, the funds rotate to the defensive sector, the telecommunications, right? Last week we do see a very strong selling on the property, industrial, technology, and the constructions sector. Now, FKI will still keep a bullish bias with our stop loss plan change at 1535. Meanwhile, FCPO we see is moving sideways for consolidations. We set our stop loss at 4006 right now. And as for this morning trading stocks, I'll be looking at firstly the plantation counter TSH resources that managed to break past 1 ringgit and 24 cents. As long as stay above this 1 ringgit 24 cent breakout point, TSH may climb towards 1 ringgit 33 and followed by 1 ringgit 40 cents. Downside support is 1 ringgit and 18 cents. Secondly, we have the Telecom Malaysia eyeing to break past 7 ringgit and 20 cents. If breakout happened, Telecom Malaysia will be climbs towards 7 ringgit 40 cents and followed by 7 ringgit 70 cents. Downside supports mark at the 7 ringgit mark. So we have TSH resources, breakout counter, and a pending breakout Telecom Malaysia. So I stop here and pass on to Sian on the weekly economic updates. Thank you.
Thanks, Joseph. So, morning, everyone. Please allow me to share my slides. Okay, so basically for the week, so we do see that tariff tensions do weigh on the risk appetites. So renewed US-China trade friction, so including the potential triple-digit tariff tied to China rare earth export curbs, has unsettled the markets. So foreign firms now require approval to export items such as graphite and lithium batteries. So as also shown by our RHB risk sentiment index has also dropped. So amid concerns over a renewed US-China tensions as well. So a short-term shift to defensive assets appears prudent. So although the persistence of risk aversion remains uncertain. So market may stabilize if US-China talks resume or if the tariff concerns ease eventually. So separate another event that we are watching for is the 5th of August 2025, which we will see the results of the US Supreme Court hearing on US global trade tariff. So basically for now, so it actually featured the debate on whether the Trump move to impose the reciprocal tariff on all the trading partners under the IEEPA is actually legal or not. So under this act. So this is something that we are watching for in the upcoming 5th of November. So other than that, we have also seen that there's a magnified risk of OPR of October FFR cut by 25 basis point. So the latest FOMC minutes report do suggest that the official outlook remains relatively sanguine. So reflecting an upgraded GDP print into 2005 to 2006 amid a stronger than expected consumer spending and business sentiment. However, so the risks are still emerged. So with the officials cited that firstly, the downside risk to the labor market has increased, while secondly, the inflation forecast has skewed towards the upside. So specifically, most of the participants judge that it likely will be appropriate to ease the policy further over the remainder of this year. Hence, we are seeing now there's a magnified risk for October FFR cut by 25 basis point. So another event on global basis, which will be the China's 5-year plan meeting, which scheduled on this week on 20 to 23rd October. So China discussion of its medium-term economic goals will also keep investor on tenterhooks So key announcement will center on China's new GDP goal target, which likely to be set at around 5%. So development plans on innovation and technology, as well as policies to support the domestic consumptions. So specifically, any mentions on its rare earth development plans will likely be a key factors shaping the immediate risk-taking appetite. Also to hope, last week we have also seen the release of Malaysia's third quarter GDP, where the third quarter GDP has actually stronger than what we anticipate. We were seeing that the third quarter advanced GDP, which taking into consideration the estimates of the first 2 months of the third quarter data, expanded by 5.2%. So stronger than second quarter's 4.4%, and also surpassing our in-house estimates of 4.1 and consensus forecast of 4.2%. So thus translating the growth at 4.7% on average in the first 3 quarters of 2025. So the stronger than expected GDP growth in the third quarter were actually driven by a sharp rebound in the mining sector. So following the resume of operations in several gas and oil facilities, and the mining sector output has actually expanded by 10.9%. So versus second quarter contraction of 5.2% for the mining sector. Meanwhile, other key sectors such as services, manufacturing, and construction are still sustaining their growth momentum. So looking forward, while now we still maintain the full year GDP growth forecast at 4.2%, but we are seeing that there is a potential, or there is likely that we were actually having our upward revision of GDP to 4.5%. We were pending for the final estimates of the third quarter GDP, so which scheduled to be released in a month later. So also in reflecting of stronger than expected advanced GDP print for third quarter. So we continue to see resilience in the construction and services sectors. Meanwhile, the manufacturing sector is expected to be supported by a sustained strength in domestic-oriented industries, continued momentum in A&A exports, and government support measures. So on Malaysia, on last Friday, we have seen the release of the September trade data as well. So while the September exports has also surged by 12.2% versus August print of 3.1%, which actually surprised the market consensus of 3.1% and also our in-house projection of 2.6%. We're also seeing a rebound in the imports by 7.3% versus August decline of 5.9%. So due to the stronger than expected September exports, so we do revise our full year export growth forecast to 4.7%, so versus our former projection of 3.4%, given the strong surge in the September exports. On year-to-date basis, for the first 9 months of the year, the exports has actually expanded by 4.8%. So the stronger than expected exports in the September, so is due to we are seeing an improvement. Actually, it's a surge of exports to the US following a few months of decline in the US export. Meanwhile, the exports to other destinations such as China, Singapore, and EU still retain their momentum, while we are seeing also stronger than expected mining output, mining sector exports, and also E&E exports in the September as well, which actually contribute to the stronger than expected surge. So, but we think that the one-off surge in the US bulk shipments is unlikely to alter our view that export growth to US might slow since the tariff has taken effect. So still resilient non-US demand and Malaysia's diversified export space should cushion softer US demand if does it materialize. So while a uniform US tariff rate across ASEAN will help to sustain the Malaysia competitiveness. So looking forward, we remain vigilant on the two potential developments. So firstly, developments in US tariff policies and regional trade dynamics, and a possible introduction in sector-specific levers, particularly on semiconductors. So that's all from me. I'll pass the line to the next presenter. Thank you.
Okay, thanks, Sian. Yeah, so this morning we are issuing our fourth quarter sector strategy for property. So the sector saw some minor sell down or profit-taking activities over the last 2 weeks, mainly due to possibly some overhang prior to the announcement of Budget 2026. And secondly, the dissolution of Sabah State Assembly that possibly cast some near-term uncertainties on the local political landscape. Thirdly, of course, with the more recent one is relating trade tensions between the US and China. So we believe market sentiment will gradually recover, and third quarter should see better earnings and property sales being reported by developers in November. So as for the budget, no significant measures for the property sector were announced on the 10th of October. The notable ones are the extension of the full stamp duty exemptions for first-time home buyers for houses priced up to 500,000 until end 2027. And secondly is the flat stamp duty for foreigners from 4% to 8%. So we think the demand for mid-range residential properties will continue to be supported. And also, the higher stamp duty will unlikely dampen demand from the foreigners on the higher end segment, given the infrastructure and economic catalyst in Iskandar, Malaysia. And over the last 2 years, we did see that despite the 4% stamp duty, Iskandar, Malaysia property market was very, very hot. And, all the resi, commercial, industrial properties saw encouraging take up over the last 2 years due to, the upcoming completion of RTS as well as the incentives under the GSSEZ. Elsewhere in the KLCC area also, we understand that some foreigners are snapping up high-end units that was developed by E&O and also Pavilion Group. Therefore, we think the higher stamp duty will unlikely dampen the demand from foreigners. So in the second half this year, we expect property sales and earnings to be stronger, which is in line with our historical trend. Many developers are ramping up their launches from late second quarter onwards, and none of them have revised up or down their property sales target so far. And based on our observations, the property market in Iskandar, Malaysia remains robust, while demand for township properties, mid-range high-rise resi units, commercial shops and industrial properties remain strong. So new launches by, let's say, Masing, the M Grand Minori, Eco Botanic Tree by EcoWorld have already received overwhelming sales response during the unit pre-selection stages in August, and hence all these projects will contribute positively to property sales from fourth quarter onwards. Upcoming launches worth watch out is by Sunway Majestic, which is a project at Yaya Awal, and also UA development, which is near RTS. And this should continue the demand momentum in the KL. In line with historical trend, we expect construction activities to accelerate after major festive seasons in the first half this year. The higher progress billings should then translate into better earnings for developers in second half. So based on our recent discussion with a few industry players, many shared that the queries or interest from DC players have seem to have slowed down lately. Although nevertheless, Signprop and EcoWorld remain focused on delivering the data center facilities that they have signed on for with Pearl Computing Malaysia. Both companies have started the construction activities on their respective DC facilities, while Signprop should award the contract for the second facility soon. Despite the slowing down demand from DC players, developers are still actively looking for more development land, as strong property sales led to a high land bank depletion rate. Many tier 1 developers such as EcoWorld, Signprop and Masing, they are all looking for new land in Iskandar, Malaysia, MDB2, Klang Valley as well, for industrial and residential development purposes. So the robust demand for land parcels should continue to drive the real estate transactions over the next 1 to 2 years. So in terms of valuations, the KL property index have partially recovered from the sell down in early this year. Recall early this year, market was affected by the US announcement on the AI chip restrictions. So the sector continued to recover, but the recent market headwinds have again interfered with the recovery. just temporary in our view, and the sector is currently trading at 53% discount to our NAV. That's between +1 ST and the long-term historical mean. So overall, we are still maintaining our overweight sector rating. We continue to like Sunway and also Sanggabi Property. We expect their solid track records of diversified business models and property products, monetization angle for their strategic investment asset portfolio as well as businesses should continue driving the share prices. That's all from me. Let me pass to David.
Okay. Thanks, Scott Wen. So this morning we have a company update note on Public Bank, where we are upgrading our call to buy from neutral with a new 5 ringgit TP from 4.75 after a roll forward in valuations. We are turning more positive on the stock in anticipation of our 2 upcoming events. Firstly is LPI's special dividends that they are expected to declare from their TBK stake disposal. And secondly is the adoption of Bank Negara Malaysia's new credit risk capital framework, which will take effect from 1st July 2026. Now, LPI, recall that they intend to distribute 70% of the proceeds from disposing of their stake in Public Bank in special dividends. And that could actually see Public Bank receive about 287 million from that, or it's going to be a 10 basis points uplift to their capital ratio. But the bigger uplift to capital is going to come from this new capital framework that Bank Negara has is set to implement from 1st July next year. And that could free up another 1.3 to 2.6 billion in terms of capital. This is based on a potential uplift of 50 to 100 bips to the CET1 ratio, as well as management has said that their comfort level for CET1 is at 12% at the bank and 13 to 14% at the group, which they were already at second quarter. Collectively, these events can unlock about 1.6 to 2.9 billion ringgit or 8 to 14.8 cents per share in excess capital that Public Bank can return to shareholders. Now, this excess capital to return to shareholders, you can do it in the form of either share buybacks, special dividends, or you can actually increase ordinary dividends. But our sense is that they are leaning towards special dividends because it's quicker to give back to shareholders, and there's also a more immediate impact that will be positive for the ROEs, which we estimate could help boost ROEs by up to 55 basis points. Operationally, if you look at things are pretty much still okay domestically. Loan growth is on track. Margin will be under pressure in the near term due to the policy rate cut as well as a loan yield dilution. So no change to our forecast. Upgrading to a buy from neutral with new target price of 5 ringgit. Okay, that's all from us today. Thank you for joining us. Happy trading and see you again tomorrow, 8 a.m. in RHB Morning Kappa at 8. Thank you.